As you know, partnership is an agreement between partners to run a business for profit. And partnership deed is a written agreement between partners which is duly registered and stamped. Its main contents are the name of the firm, nature of business, place of business, profit sharing ratio, and agreement on interest on capital, interest on drawings, salary of a partner, and rules relating to admission, retirement, etc. If there is no partnership deed, then which rules are applied? These rules are specified in the Partnership Act 1932. It states that profits are to be divided equally. No interest on capital is to be allowed or interest on drawings to be charged. No partner can claim salary or commission, and if a partner has given loan to the firm, he is entitled to interest on loan at the rate 6%. Now, let us discuss what is a profit and loss appropriation account. This is basically an extension of profit and loss account. And this account is prepared to show distribution of profit as per the terms of partnership deed. Profit and loss appropriation account is prepared in the following format. First of all, the net profit as given in the question, which was calculated as per profit and loss account, is brought down on the credit side. And if interest is to be allowed on the loan given by partner, it is subtracted from net profit because interest on loan is a business expense. And on the debit side, we write all those items to which the partners are entitled to. Interest on capital, suppose there are two partners A and B, salary of a partner, commission to a partner, and some profit, if it is to be transferred to general reserve, is reflected on the debit side as transfer of profit to general reserve. On the credit side, interest on drawings is written because it's a business income, and the remaining profit is to be divided in the profit sharing ratio. And if this profit sharing ratio is not given, it is to be divided equally. Recap the format of profit and loss appropriation account. On the credit side, net profit brought down, subtract interest on loan. On the debit side, interest on capital, salary of a partner, commission to a partner, any profit transfer to general reserve, and on the credit side, interest on drawings, and the remaining profit is to be divided in the profit sharing ratio. Remember, interest on loan, as already mentioned, is a business expense, so it should be subtracted from the net profit. And number two, if profit given in the question is after salary, it should be added to the net profit before solving the question so that salary is shown on the debit side. The reason why it should be added, sometimes we need to calculate commission to be allowed to a partner, which is on net profit of the business. Therefore, if profit given is after salary, it should be added in the profit so that we can do the remaining calculations correctly. Let us take a simple example on the topic. B and C are partners sharing profits and losses in the ratio 2:1, had capital of rupees 50,000 and 60,000 as on 1st April 2013. Interest on capital is allowed at the rate 12% per annum, and B is allowed a salary of rupees 12,000 per annum. C is allowed a commission of 10% of the profit left after interest and salary. Suppose further, profit of the firm for the year ending 31st March 2014 before interest on capital but after charging salary of partners was rupees 60,000. Please note that the profit is given after subtracting salary of a partner, and salary is allowed to be, and show distribution of profit. And like this, profit and loss appropriation account, net profit brought down, which is now 60,000 plus 12,000, because 12,000 was subtracted from net profit, and profit is 72,000. And on the debit side, we'll write interest on capital. For B, it comes to 6,000, and for C, 7,200, and total interest on capital 13,200. And now we write salary of B on the debit side, 12,000, and commission of to C is calculated on profit, which is left after subtracting interest on capital and salary of B. So from 72,000, we're going to subtract interest on capital and salary of B. And on the remaining profit, we calculate 10%, and this comes to 4,680. And the remaining profit, which is to be divided between A and B, is 42,120. So divide this into the ratio of 2:1. Proceed further. Treatment of commission of manager. This is also treated as a business expense. Therefore, it should be subtracted from the net profit. So it means commission of manager is a charge on profit, and is a part of profit and loss account and not profit and loss appropriation account. So therefore, manager commission is to be subtracted from net profit. And how do we calculate? If the question states commission on net profit, that is commission of manager, on net profit before charging such commission, and the formula is net profit into rate upon 100. And if the wording is commission on net profit after charging such commission, the formula is net profit into rate upon 100 plus rate. So if commission is 10%, the formula will be net profit into 10 upon 110. Now let's discuss meaning of capital accounts. Capital accounts of partners can be prepared and maintained in two ways: fixed capital accounts, fluctuating capital accounts. First of all, discuss what is fluctuating capital account. If capital of partners are allowed to change with all adjustments relating to interest on capital, interest on drawings, salary of partners, profits, drawings, etc. Therefore, the capital change, it is called fluctuating capital account. Let's see how it changes. Balance brought down, that is the balance of capital given in the question. Additional capital, if introduced during the year, is added in the capital by cash. Capital withdrawn, capital to cash, interest on capital, salary allowed to partner, commission allowed to partner, and profit as distributed in P&L appropriation account is written in the capital account on the credit side, because these are additional in the capital. Drawings of partners is deduction from capital, and similarly interest on drawings, and the balance is carried down. You see, the capital brought down and carried down changes. The brought down changes to carried down with all adjustments for additional capital, capital withdrawn, interest on capital, salary, profits, drawings and interest on drawings. That's why it's called fluctuating capital accounts. And if capitals are fixed, no change is made in the capital except with additional capital or capital withdrawn. How about the remaining adjustments? Therefore, current accounts are prepared to reflect adjustments for interest on capital, drawings, etc. Why capitals is made fixed? In case the partners want to reflect their investment separately and not to mix up the other adjustments. Therefore, fixed capitals are made. So when capitals are made fixed, two accounts are made, capital account and current account. On understanding how the capital account will look. This is a balance brought down, which is opening balance, additional capital introduced during the year, and capital withdrawn, and balance is carried down. Therefore, brought down and carried down changes only with capital introduced or capital withdrawn. All adjustments will be reflected in current account. So if current account has a balance given in the question, balance brought down, which is a credit balance, and if it is a debit balance, it is brought on the debit side. All adjustments which were written in capital account now are written in current account, as I shown it. Interest on capital, salary, commission, profit. And on the debit side, drawings and interest on drawings, and the balance is carried down. So you notice when current account, when capitals are fixed, we make capital account separately and current accounts. So that's end of the lecture 1. So in next lecture we shall be proceeding on the calculation of interest on drawings and some cases interest on capital.